now let me introduce him finally after this little detour. Zacharias is now at the Frankfurt School of Finance and Management. He is there a professor of finance and the head of the finance department. I'm not sure whether it stopped at the end of last year, but he's also now the academic director of the Corporate Governance Institute. He has been at very international outfits before going to Frankfurt. I won't mention them all. Let me mention that he has received various awards for papers he has written, for research he has done, and he has been the keynote speaker at very many well-known conferences. He's also very present in international media, so you can read articles, interviews of him, and see little TV clips. And he's also a distinguished scholar in the German system. He's ranked very highly, #2 in the business administration area, #1 in finance as professors below a certain age. And he's producing lots of publications in highly ranked journals. So I think that is enough to motivate you to listen closely to what he is going to say. He's speaking on a topic which affects us all and which has come to the forefront of research in recent months and years. The topic of today's talk is climate risk disclosure and institutional investors. And Zacharias, I'll give you the word, and we're very happy and proud to have you here.
Thank you very much, Rüdiger, for the introduction. Of course, you know, expectations are way too high now. So I'll try to give my very best in the remaining 45 minutes of my presentation. What I should say is that basically all of my work is basically thanks to my co-authors that I'm able to work together with, and the same holds here. So what I'm presenting today is joint work with Emirhan Ilhan. He's a PhD student here at Frankfurt School, with Philip Krüger. He's at University of Geneva, and with Laura Starks. She is at UT Austin. And like Rüdiger said, we're really eager to get your thoughts, your comments, your feedback on this paper, because we're currently revising it. And what I'm presenting here is based on a series of fantastic comments we got, you know, from referees. And of course, you know, we also, you know, before sending the paper back to the journal, are eager to hear what your thoughts are, and, you know, whether we should, you know, add things, change things, make things differently. So any views are really appreciated. We need them for the paper. Yeah, as you just said, it's on climate risk and institutional investors. So we're basically trying to understand what the relationship between these two variables is, whether there's an effect of institutional investors on climate risk disclosures of firms, or whether there's an effect in the other direction, or whether both effects are present. So I'll be much more specific on all of this moving forward. So it's a great opportunity to be starting here also this specific series, because I know a little bit about finance and institutional investors, but many of you are experts either in asset pricing or in energy finance. You know, so I'm probably also able to learn from your comments as we go along. The objectives of my talk are basically threefold. So first, I want to give you some evidence on this relationship between institutional investors and climate related disclosures. But I think beyond that, I also want to convey that, you know, that the results suggest that there is some hope in terms of all of us combating the climate crisis that we're facing, some hope that capitalism, that institutional investors can play a crucial role in helping to combat climate change. And, you know, let me just, you know, preview very quickly why I believe this matters here for this topic. Well, the reason is that climate related disclosures actually have been shown in other papers to affect carbon emissions, in particular of companies. So firms that disclose more on their carbon risks, on their carbon emissions, have been shown to also reduce carbon emissions in subsequent periods. So therefore, if we find, as I'll show you, that institutional investors positively affect climate-related disclosures, there's hope, because eventually this should also then lead to lower emissions by the companies moving forward. But also, I think there's some action guidance if you're more kind of from the policy-oriented side here, regulation, lawmaking, and so on, because I'll also convey, based on some of the results, where there's more work needed to be done when it comes to regulation of climate-related disclosures. Before I jump into this paper, given that we have a bit of a broader audience here today, I want to abuse the time of the seminar to advertise a little bit some of my other work. And I want to do that because I deeply believe that this work is important. It's very close to my heart, and I'm not just saying that as a father of kids, and thereby someone that really cares about how the climate affects the world, but also because I think this is really an area where research can positively affect policy making and the behavior of institutional investors. So my first paper that I want to mention here as part of my broader research agenda on climate finance is a paper I have with Philip Krüger and Laura Starks. And in this paper, we did something very simple. We ran a questionnaire, a survey among institutional investors in order to try to understand whether and how they address climate risks in the investment process. Right? So if you want to get a bit of a feeling what, if at all, investors are doing, this could be a useful paper. It's also, I think, a bit of an introduction into the topic of climate risks, because this displays the various channels through which institutional investors may address climate risks in the investment process. Then my paper, Carbon Tail Risk, with Emir Hahn and Craig Wilkoff, takes a bit of a different approach. There we try to see whether, because of anticipated regulation combating carbon emissions, we see that firms with higher carbon emissions have higher tail risk. And that's exactly what we find. So it seems to be that firms that emit a lot of carbon face big regulatory climate risks that investors try to insure themselves against, right? So we find that if you look at option markets, the prices that investors are willing to pay to get insurance against large downside tail risks are higher for firms that are producing a lot of carbon emissions, right? So the market is starting to price carbon risks that are related to carbon emissions and the future regulation that is likely to come about here. Then the other two papers, they try to address something that I've observed, others have observed in this literature, which is that there is a lack of firm level measures of climate change exposure for firms, and a measure that is not just at the firm level, but that is also varying over time and allows us to decompose exposure into risks and opportunities, because of course, some firms have exposure to climate change but may benefit from it, while others have exposure to climate change but may suffer from it, right? So we have a measure at the firm level that tells you how big the exposure of a given firm to opportunities and risks are. And in particular, also once you look at the risk part, where there's more exposure to physical risks or transitional regulatory risks. And so how do we construct this measure? It's a measure that's publicly available for everyone to download, by the way, for more than 10,000 firms around the world. Well, what we basically do is we're looking at conference calls, right? So if you're not from finance, conference calls are events, usually on a quarterly basis, when firms are reporting their earnings, in which management and analysts are coming together to discuss pressing issues that firms are facing. And what we do with this measure is basically counting the relative frequency with which climate-related topics are discussed in these calls. And of course, this is not a simple exercise, especially if you want to decompose also whether it's about opportunities or risks. So what we're using is a machine learning guided algorithm that helps us identify points in the conference call conversation where analysts and management are discussing climate topics, right? So it's in a sense a measure of perceived importance of these firm level climate change exposures that we're measuring. So this paper is together with Craig Wilkoff, with Lawrence van Lent and Weishen Zhang. And in a accompanying paper, we show that this measure seems quite reasonable. For example, it seems to be priced in equity markets if you take it to the data. And we're lucky that a series of other papers have recently also validated our measure and show that it's related to other outcomes like cash holdings and so on. Again, that the measure is publicly available because we really believe that not just practitioners but also academics need more measures to capture the exposure of firms to climate change. And of course, there are some measures available, but as we argue in the paper, they have lots of shortcomings, right? For example, carbon emissions, they only capture transition risk and only that to a part. Measures provided by companies like ISS and Sustainalytics, they are very selective. They're not covering many firms. And also not over a long time period, and so on and so forth. So we hope to also provide a service to the profession by making this measure available. But that's mostly about other work. I think it's useful, so you get a bit of a framework here in what I'm trying to discuss in this paper. So in this paper, we have a look at disclosure. And I think it's pretty clear that for financial markets to do their job well, they need timely and accurate information on firms' risks exposures. And of course, in particular, also now, given its increasingly big relevance on climate-related risks and opportunities. So financial markets need this information to make the right and informed capital allocation decisions, but markets also need this information to price climate-related risks and opportunities, of course. Right? In fact, several people have said that the reason why we care so much about disclosure is because otherwise, the markets can't do their jobs in pricing climate-related risks and opportunities properly. And thereby also, of course, there is a dimension of financial stability to disclosure. Right? So if markets don't price risk correctly because there's too little disclosure on the risk by the firms, then this quickly also has implications for financial stability, right? If you don't know where the risks are sitting in the financial system. I think back of the financial crisis where there was a lack of disclosure on certain assets and we didn't know where the risk was sitting. And I think it's similar here in this domain. So disclosure on climate-related risks is highly important for investment decisions, for financial stability. At the same time, despite this importance, there's a common view among regulators and investors that the current disclosure practices are insufficient. Right? And I think I need to motivate this a lot. If you read this newspaper, you read about this almost on a daily basis, and forthcoming and expected regulation to address the limitation. But just two quotes here. One is from Mark Carney, the ex-governor of the Bank of England, who called for more to be done to develop consistent, comparable, reliable and clear disclosure around the carbon intensity of different assets. And he also said that companies needed to increase the quantity and quality of the climate-related disclosures. And as you know, he's very active at the moment on the policy side, also in terms of preparing the next COP meeting in Glasgow, to address these issues also through regulation on a global scale. And the ex-CEO of Norges Bank Investment Management, the biggest asset owner in the world, Slyngstad, he stated that the only surprise is how hard it is to get the data, so climate-related data from portfolio firms. And he continues by saying, I think it will take years to get good data from the majority of companies who are invested in. Right? So investors and regulators are seeing big shortcomings in current disclosure practices. So what we do in this paper is the following. So we try to provide systematic evidence from a questionnaire and from archival data observational data on the preferences of institutional investors with respect to climate-related disclosures. We basically make 3 points. First, we show using survey and archival data that institutional investors value and demand climate-related disclosures. So they want to have more disclosures by firms. We show that the disclosure demand is affected by climate-specific disclosure costs and benefits. Right? So investors are not just demanding across the board, one size fits all from all firms, more disclosure, but they take into account that disclosure costs have heterogeneous costs and benefits across firms. So this seems to be taken into account. And we also show that influence and selection effects explain the relationship between institutional investors, ownership in firms, and these firms' disclosures. So it's both that investors are positively affecting the disclosure of portfolio firms, kind of pushing them to disclose more, but also that they have bigger holdings in firms that are disclosing more, right? So there's an influence and a selection effect going on. So just to say a few words about the data, and I think it's important to understand that in what I'm going to show you, they're basically 2 surveys I'm using. So I hope I don't confuse you. The first survey is a survey that I and my co-authors were running as part of this earlier paper, importance of climate risk for institutional investors, among institutional investors, where we asked institutional investors how they think about climate-related disclosures. Right? So that's a survey, and I'll show you a few results from that survey, basically to motivate the archival analysis. Now, in the archival analysis, there's also a survey component, right? Because in the archival analysis, we measure disclosure by companies based on a survey that the CDP, formerly called the Carbon Disclosure Project, is running among firms, right? And it's basically sending out questionnaires to firms in order to get information on these firms' climate-related risks and opportunities. So in the archival analysis, the outcome variable, so to speak, is from a survey, not from our survey, but from the survey that the CDP is running. Good. So in the archival analysis, right, not our own survey now, but in the archival analysis, we're linking disclosure to CDP on climate-related risks to institutional ownership. Right? So we basically look at a large sample of firms, see whether firms are disclosing on their climate risks and how the institutional ownership of these firms looks like. Now, usually I would start with giving some hypotheses here that we're testing in the data, but I thought it may be easier for everyone to understand the hypothesis if I first start with explaining measurement, how we measure institutional ownership and how on the next slide we measure climate-related disclosures. So basically what we try to do is we're trying to not just throw in a variable that captures whether you have 5 or 10 or 20% institutional ownership in your company, but we try to measure specific aspects of institutional ownership that is more likely to tell us something about whether investors are climate conscious or not. Right? It's not perfect measures, so therefore we also have 3 of them. And if you have ideas on how to improve this, please let us know. So here are the 3 measures of quote unquote climate conscious institutional ownership. The first measure starts by saying that ownership from institutional investors that originate from different countries may be useful to capture climate conscious ownership, because we know from other research that institutional investors across different countries are subject to different stewardship codes that aim at promoting corporate sustainability. And the idea is, if you're an investor that is coming from a country where you're subject to a stewardship code that, if you're a signatory of it, commits you to promoting corporate sustainability across your portfolio firms, then it's more likely that you also have a higher propensity to demand climate-related disclosures from your portfolio firms, right? So therefore, we capture, what part of institutional ownership is subject to stewardship codes in their respective home countries. Second, we measure demand for climate reporting, climate-related disclosures based on whether institutions are originating from countries where societal norms make them more climate conscious, right? So for example, investors that are coming from Scandinavian countries have been shown to be kind of more having strong environmental norms. There are papers showing this, and we use data from other work that classifies countries based on their social environmental norms and capture in a given firm what fraction of institutional ownership comes from high norm countries. Again, also here, the idea is that investors from these high norm countries are more climate conscious. The third variable captures whether or the ownership from so-called universal owners. So universal owners are investors that are very diversified, basically hold the universe of stocks. And so we argue that such universal investors, think of NBIM, Norges Bank, or think of also the big three, State Street, Vanguard, BlackRock, they should care a lot about climate issues because they're exposed to climate-related externalities in their portfolio, right? So if you hold the universe of firms, you have a strong incentive to demand disclosure, for example, among high polluting firms, right? Because as I've told you before, if these firms are disclosing more on their carbon emissions, they may also be moving forward more likely to reduce emissions. And you benefit from this, not just because the risk of that specific company is reduced, but also because if emissions at large scale among the high carbon emitters are decreasing, the other portfolio firms are benefiting from it because the externality is lower, right? And if you hold hotel companies, real estate, and so on, you're going to benefit from this as well, right? So therefore, also here we argue, because these externality benefits are likely to be larger for universal investors, that they have a stronger preference for climate-related disclosures. So later, these are going to be my three measures of climate-conscious institutional ownership. We're going to relate them to the following measures of climate-related disclosure. So first and most simply, we measure whether a firm discloses information on its scope 1 carbon emissions, so that the direct carbon emissions under the chimney, so to speak. Results are very similar if you look at scope 2 or scope 3 emission, but especially the latter one are available for just a subset of firms. But then we say, well, yeah, scope 1 disclosure is useful. It tells you something about carbon risks, regulatory transition risks, but climate change has much broader effects. So we also capture in a variable called climate risk disclosure, whether you disclose more broadly, not just on regulatory risk, but also on physical and other risks. So in the survey that the CDP is running, they have questions in which they ask firms to disclose on their regulatory, physical, and other climate-related risks. And what we basically do is we basically look at whether firms disclose on these risks as well. Right. So, and we're going to use a variable that is basically 0 if you don't disclose anything to the CDP, 1 if you disclose on one of these 3 types of risks, and then 2 and 3, 3 if you disclose on all 3 types of risks. The next measure is somewhat different. It's a score that measures how complete a firm's survey response to the CDP is. So it's a measure of the overall quality of the disclosures to the CDP. So the CDP survey has many different questions. I've just told you about some of them: scope 1 disclosure, climate risk disclosure, broadly defined. And with the third measure, we basically capture whether you respond to 30%, 50%, 100%, or 0% of the questions. So these are going to be our 3 main variables. I should add, they're not available for all years because of some of the questions were added or deleted. So if you wonder later why number of observation varies a bit, that's the reason. In complementary tests, what we also do is we just look at CDP disclosures and look at within these firms, whether firms are verifying their emissions, so have a third party that provides an audit of the emissions, and also whether firms that are disclosing to the CDP are breaking down the emissions in terms of where they come from country-wise. Not in this talk, but in the paper, we also look at disclosures in the annual reports, in the 10Ks. Basically, we don't find a lot of results there in terms of the effects of institutional ownership, climate-conscious institutional ownership. And the short reason that we give why this is the case is because we believe the 10K disclosures are much more subject to greenwashing than the questions in the CDP survey. They're much more under the control of management. So therefore, it seems that investors are pressuring firms more to disclose in the CDP survey than in the 10Ks. This may change, by the way, because there's going to be checks by the SEC whether climate risks have been addressed properly in the 10Ks. So moving forward, that may look different. So here's the baseline hypothesis that we want to test. Is there a positive relationship between climate conscious institutional ownership in a firm and climate related disclosures? Looking at these 3 disclosure variables I told you. And then we say, like I mentioned in the introduction, well, climate related disclosure is costly. So investors should not just pressure all firms to disclose, they should pressure firms more strongly where the disclosure costs are lower. And they should push firms more strongly where the externality benefits are larger. The same the other way around, firms should find it cheaper or should be more willing to disclose if the costs are lower. The benefit here is a bit of a different argument because it's an externality benefit. The firm doesn't internalize it, right? So the externality side is then more from investors pressuring firms more to disclose if the externality benefit is larger. So let me just say a few words here about these costs. So there's work showing that one cost of climate-related disclosure, ESG disclosure more broadly, is proprietary costs. What are proprietary costs? Well, these are costs that come when you disclose a lot of, in particular, detailed information on climate risks that is confidential, right? So if you disclose, for example, your kind of future emissions, that may be proprietary information that competitors may learn something from in terms of your future product market strategy and so on, right? So therefore, the argument in the literature is that firms should disclose less, institutional investors should demand less of disclosure if these proprietary costs of the disclosure are larger. And in the paper, we give a lot of anecdotal evidence actually that these costs really seem to matter a lot. How do we capture this empirically? Well, basically, we consider the role of competition, and we're going to test whether the effect of institutional ownership on climate-related disclosure is weaker among firms where these proprietary costs are larger, as reflected by higher competition, right? So these firms being in a more competitive product market environment. Similarly, for information production costs, it's very costly to disclose on your climate risks because most firms don't have the processes, don't have the organizational structure to do it, right? So it's not just something that is very easy to do. So also, of course, here, they should be taken into account by firms as well as institutional investors when they demand or supply climate-related information. So there's the argument in the literature that these information production costs likely have a big fixed cost component, which makes a lot of sense. So therefore, they should be relatively less relevant for large firms. So here we're going to test whether the effect of climate-conscious institutional ownership on climate-related disclosure is stronger among larger firms where these information production costs should be less of an issue. Finally, in terms of the externality benefit, we test whether the effect of institutional investors on climate-related disclosures is stronger among firms where there is a bigger benefit from the disclosure because they produce more carbon emissions, so they generate larger externality. So institutional investors may benefit more from such firms' disclosure because these are the firms where you particularly care about the accountability that comes with the disclosure and potential future reductions in emissions. So in order to understand whether effects are coming from an influence effect or selection effect, we explore in the paper, and also I'll show that in the presentation, 3 shocks basically, 2 shocks to the demand, climate-related information, and 1 shock to the supply. The shock to the demand comes from a French law that maybe you have heard of, French Article 173, passed in 2016 in France's path towards the climate summit in Paris, and in Paris, and what the law, and in particular French Article 173, part of this energy transition law, says is that French institutional investors also need to disclose information on their carbon risks. And so if you're a French institutional investor and you're now subject to this law, which means that you need to also now disclose on your portfolio firms' carbon risks and other climate risks, right? This, of course, is a shock to your demand of this information, because now you need to deliver that to the regulator. So therefore, you have a much stronger demand vis-a-vis your portfolio firms to get this information. So we exploit this French Article 173, and basically will show you that for firms with lots of French institutional investors, from before to after the enactment of this law, there's an increase in climate-related disclosure of portfolio firms, right? Of portfolio firms, especially those owned by many French institutional investors. The next shock we're going to consider is related to Climate Action 100+. So this is a big and important and influential investor coalition in which major institutional investors come together in order to engage with the biggest carbon emitters in the world. And one of the goals of Climate Action 100+ is to increase these firms' climate-related disclosures. So we basically test and show that once a firm gets added to this list of Climate Action 100+, this becomes an engagement target, then these firms also improve their climate-related disclosures, especially the quality of their disclosures. Right, and that's also a shock to the demand, right? Because now you add it to the list, and the investors that own you have a stronger demand now for information because they want to fulfill what they committed to as part of Climate Action 100+. There's a shock to the supply that we're going to explore, and that comes from a law in the UK that made carbon disclosures mandatory from 2013 onwards. Right, so if a firm has not disclosed carbon emissions before the law, but now is mandated to do so, that firm has a supply shock to climate-related information. And we're going to see how firms that are now forced by the law to disclose carbon emissions experience changes in institutional ownership. And we basically show you that institutional ownership, especially from the climate conscious type, is increasing in these firms that prior to the reform did not disclose carbon emissions and are now forced to do so. Evidence for a selection effect. Good. Any questions at this point that I should clarify? If not, then let me just give you an idea of the questionnaire that we ran. That's not the archival analysis that most of the later slides will be based on. This is just to motivate the archival analysis. And basically what we did was running a survey among a global group of institutional investors. More than 400 responded. And we tried to basically understand how they think about climate-related disclosures. And we have a few insights. The first insight is these investors that we survey, they believe that climate-related reporting is very important compared to financial reporting. You see the numbers here. Of course, there's a selection. We are surveying investors that probably care more about climate reporting than non-responding investors, and probably it also reflects that financial reporting is already quite mature. But just eyeballing here, the figure shows you that investors believe climate reporting is very important. At the same time, they tell us that current disclosure practices are insufficient. Management discussions on climate risks are not sufficiently precise, they say. There's a lack of firm-level quantitative information on climate risks. And they also, in addition to that, say that they have started to demand from portfolio firms to disclose more on these firms' exposures to climate risk, right? So if you look at the bottom, a lot of the investors strongly agree that investors should demand more disclosure, right? So later I'll show you evidence for these demand effects, right? So this survey response is a kind of corroborating evidence that what we find later does make a lot of sense. So if you ask investors, do you demand and engage firms to disclose more? That seems to be going on, at least for those that we surveyed here. And it's also consistent with another piece of evidence from our questionnaire. So we also asked them whether they engage or plan to engage portfolio firms to report according to this TCFD, the gold standard of climate-related disclosure recommendations. A lot of the investors say yes, they do. And we also find that quite a few investors say they either disclose or plan to disclose their own carbon footprint, which in turn then also means that these investors should have a stronger demand for climate-related information from portfolio firms. That was our survey. So let's now move to the archival analysis. So our outcome variable are these climate-related disclosure variables, which we get from the survey run by the CDP. Right? So just to give you some background information, the CDP is an organization set up by institutional investors, which sends an annual survey to firms and other organizations, asking them different questions related to climate risks. And then you as a firm, you can decide whether you respond to the survey or not, right? And many firms don't respond to the survey. And basically what we use in the subsequent tests is measures that tell us whether a given firm responded to the CDP survey or not, right? And if you don't respond to the survey, you don't disclose information. If you do, you do, right? And that for all the different variables that I'll show you later. Now, a challenge if you look at CDP data is that, if you have a firm that is not in the CDP sample, you don't know whether the firm was not requested to participate in the survey or whether the firm was requested to participate but refused to provide answers. And of course, what we want to capture is only the latter, right? If a firm did not get the survey and therefore didn't participate, that's not what we're after. We care about firms getting the survey by the CDP and then consciously deciding not to respond to it, right? That's what we would classify as non-disclosure on climate-related risks. So therefore, what we basically do is, following a paper by one of my co-authors, we look at different countries, look at the largest firms in the different countries, and then see whether a firm in the kind of major index in a given country responds to the survey is in our sample or not. If it's in the sample, it's disclosing to the CDP. If it's not, we assume it did get the questionnaire but decided not to respond to it. So think of now the following regression settings. The dependent variables are in columns 1 to 3. Do you disclose your scope 1 emissions or not? In columns 4 to 6, a variable between 0 if you don't disclose to CDP, and then 1, 2, 3, and the higher it is, the more the more information you provide on these different climate-related risks, right? Regulatory, physical, other risk. By the way, that follows a paper by Carolyn Flammer and co-authors this measure. And then finally, column 7 to 9, the dependent variable is the score. How complete is your response to the CDP, right? It's 0 if you don't respond, and then it can go up to 100% if you respond to all questions in the CDP. And we regress these 3 variables on the 3 measures of climate conscious institutional ownership, as well as the residual parts of kind of non-stewardship code, low norm, non-universal owner IO, as well as a set of firm level controls and firm fixed effects and fixed effects. And what you see here is that overall there's a positive and significant relationship from just eyeballing the different columns between climate conscious institutional ownership and climate related disclosures, right? So firms that have a higher stewardship code institutional ownership, high norms ownership, higher ownership by universal investors, universal owners, they also disclose more to the CDP on climate related risks. And the effects are meaningful economically. What we then do is basically look at these costs and benefits by now interacting the institutional ownership variables with a measure of the proprietary disclosure costs, a measure of the information production costs, and a measure of the externality benefit, right? And the first finding that we have is that the effect of climate conscious institutional ownership on climate related disclosures is moderated, gets weaker when you have firms where these proprietary disclosure costs are larger, as predicted by theory. They're magnified among large firms where these information production costs are likely to be smaller. And they're also magnified among firms operating in highly carbon polluting industries where the externality benefit is likely to be higher of the disclosure. Right? So consistent with different theories, we find that costs and benefits are taken into account when it comes to this effect of institutional ownership on climate-related disclosures. Then we look more closely at these influence and selection effects in order to kind of see whether the relationships, the correlations that we've just produced originate from investors actively engaging firms to disclose more, or the other way around, from climate conscious investors having a propensity to invest in firms that provide more such disclosures. We look at these three settings, and in the remaining minutes, I'll just give you the basic idea of what we find there. So the first test is looking at this French Article 173. So we basically look at firms before and after 2016. This is when this law became active. And we compare firms before and after the article that have high versus low institutional ownership from France. And so what you see in columns 1 and 2, as well as columns 4 and 5, is that there's a positive effect. So after the French Article 173 became active, disclosure improves, especially among firms where there are lots of French institutional investors, right? So these investors that have this shock to the demand of climate-related information. Now, this effect is even stronger in columns 3 and 6 among French firms. That's not surprising because French firms, part of that, French law, were also forced to disclose more on climate-related risks. But it's important to see that the effect is not just originating, right, from the French firms, right? The double interaction post-Article 173 times high French IO remains positive and significant. So it's also non-French firms with high French institutional ownership that are disclosing more. We can't look at this completeness score in these regressions that I had earlier because it isn't available for most of the post years after 2016. Okay, so after the French Article 173 is enacted, disclosure of firms with many French institutional investors improves. That's consistent with the investors from France having a demand shock to climate-related information, because now they have to disclose climate-related information themselves. Climate Action 100 plus. So there are about 160 or so firms that are targeted by this investor coalition. That's why it's called 100 plus. And so we look at what happens to these firms once they get added to the Climate Action 100 plus list in 2018. Now, here we look in particular at the quality of the disclosure. One reason is that in terms of whether or not they disclose, we don't find a lot of effects. That's probably because those firms, they are highly visible carbon emitters that already found it kind of worthwhile to disclose this information, did that, and those that didn't probably had very large costs of not disclosing this information. So we focus much more here now within the disclosure on whether disclosures, the firms that were disclosing to CDP or already the scope 1 emissions, whether these firms' quality of the disclosures improved. And we measure that by looking at whether these firms, as a result of being targeted by Climate Action 100 plus, were increasing the likelihood of verification of the emissions, right? Having third-party audits come in to verify that the emissions that they disclose are actually correct. And that's exactly what we find, right? So after these firms get targeted by Climate Action 100 plus, they're more likely to have their emissions verified. And also here, effects are quite large. Finally, we look at the other direction, right? We look at what happens to UK firms that did not disclose carbon emissions before the mandatory carbon disclosure requirement in 2013, and are now required to disclose emissions. How does these firms' institutional ownership change? Right? So now the dependent variable is climate conscious institutional ownership, and we test how the non-disclosures institutional ownership, climate conscious institutional ownership changes from before to after the reform. And what you see is it's improving, it's going up, right? So we find that the firms that are now disclosing previously did not see an increase in climate conscious institutional ownership. So that suggests that there's a selection effect as well, that investors are now building up or increasing their stakes in firms that prior to the reform didn't disclose carbon emissions, but are now forced because of the reform, because of the law to do so. Right. So while the first to tests provided inference that there's a demand effect, there's an influence effect of institutional investors on climate-related disclosures. These effects here show that there's also at the same time likely a selection effect whereby institutional investors, climate-conscious institutional investors, I should say, have higher stakes, hold higher stakes in firms that provide carbon-related information. So let me conclude. So it's a simple paper, but I think it's making some important observations. We show that institutional investors value and demand climate-related disclosures. Their disclosure demand is affected by disclosure-specific costs and benefits. Influence as well as selection effects explain this equilibrium relationship with the institutional ownership, climate conscious, I should say, institutional ownership and disclosure, which I think more broadly shows evidence consistent with what the FAZ was recently kind of writing, which is capitalism can help fight climate change. That's what we find. Seems to be the case. Institutional investors both positively affect disclosure, which later then, as others have shown, leads to lower or can lead to lower emissions, but also, they're reluctant to invest in firms that don't provide the disclosures, which also gives an incentive for firms to moving forward to disclose more. Right? So there's an important role for capitalism in helping fight climate change. I think that's what at least we can conclude from our analysis. So therefore, there's hope. Right, I said this already before, because if investors increasingly engage firms and demand disclosures and select to invest in firms with better disclosures, this is likely put pressure on firms to reduce emissions also moving forward. Now, why did I say that this paper gives some policy actions? Well, mostly based on our questionnaire, I think we can conclude that the investors still perceive a lot of shortcomings in the current disclosure practices and want to see much more structured, data-driven mandatory reporting. Much more on this is in the paper, but I think the paper also gives some guidelines on what needs to happen on the policy side with respect to disclosure regulation. Good, so that was a fast ride through what we are doing in the paper. I hope I didn't talk too fast. I have this tendency if I get excited about a topic, but I'm happy to clarify and reinforce some of the analysis or can explain better if you have any questions. Thank you.
Right, thank you, Zacharias, for this marvelous talk. You easily met the expectations, and I should talk very fast for my excitement of the talk, but thank you very much. So now the floor is open for questions. I think we can start by just simply make yourself visible if you want and ask a question then. Dimitros, yes?
Yes, hello.
Hi, Dimitrios.
So I am Dimitrios from CY Cergy Paris. That was very nice. In fact, I really enjoyed it. I recently read your first paper on this field, and I wanted the clarification. So can you define quality of disclosure? So I have the impression that in the beginning you talked about how full the questionnaire is, how many things I respond or the firms respond. And then in the end, I have the impression that you talked about truthfulness as well. So is it both? Is it none?
Yeah,
thanks.
I think that's a great question. So we think the two variables that get closest to the quality of the disclosure are exactly those two, or three, I should say. The first one is how complete is your survey response? What fraction of the questions do you respond to? Even so, there you may also say, yeah, you respond to a question, but you give kind of nonsense information. Okay, unlikely. And then the others are indeed, do you verify your emissions? So think of two firms. One says I have a million carbon emissions a year. The other says I have a million carbon emissions a year, and I have an auditor come in to really check that what I'm saying is true, right? So for the first firm, probably it's not likely that they are lying, but it could be that they're doing mistakes, because you don't want to lie to the CDP survey, given how many investors are behind it. You're going to really get in trouble if it comes out, but it could be that you're making mistakes. So therefore a scope 1 reported emission is of higher quality, so to speak, if it's verified. Think of a financial report that is audited versus one that is not. Right, that's how I would say it. In the initial version of the paper, we just looked at all firms and then had a variable that says, do you disclose and verify or not? And then we got the right comment that it's kind of confounding disclosure and verification. So in the revised version of the paper, we do something slightly different. We just look at those firms that do disclose to CDP the carbon emissions. Do they verify or not? And what I've shown you here is just the results on the verification for the Climate Action 100 Plus. In the paper, we also have it for the full sample, right? And then the third variable that we have, Dimitrios, that looks at quality is whether you disclose where the emissions are coming from, whether you give a country breakdown. And that's pretty important, because suppose you're an investor, right? So, you know that most likely regulation will be at the source of the emissions, right? And so it matters, where they're coming from. And, if you have most of your emissions in Saudi Arabia, you're probably less concerned than, if most of the emissions of a company come from, Norway or from Germany or some other countries that are more likely to kind of impose strict regulation. So this is important information for you to have in order to assess the carbon risks of a company. So therefore, we also say that if a firm provides emission information and says where it's originating from, this is of higher quality. But probably there's more to think about, right? And there may be other measures that can be exploited in the CDP survey.
Thank you.
Maybe I can quickly follow up on that concerning the countries, the country division you were mentioning. Did you have a look at which sort of part of the companies come from a country or region where they have a carbon trading scheme sort of implemented? You had this high emitting firms and had a result towards them on disclosure. But if they're in a trading scheme, they have to do that anyway. So
that's a very good idea. So we didn't. That's certainly something we can try to look into. That's a nice idea. Yeah, you're absolutely right. Because yeah, I mean, for two reasons. For the reason you say, of course, because of the requirement to do that, to disclose some information anyhow. So therefore, it should be less costly to provide information in the CDP survey too. I think that's a great point. And also maybe because once there's already a regulation in place, it may be easier moving forward to kind of increase the costs or reduce the kind of certificates that are out there, increase the tax, whatever the mechanism is, and therefore also the kind of potential carbon risk should be higher for these firms. So investors should then also demand from such firms more information. Right? I think that's a good idea. Yeah.
Okay. And any further questions? Heiko, yeah.
Yeah. Thanks. Great talk. I actually have several questions, so you might decide which one you like best. First is, how exactly does the investment philosophy of the investors, so active versus passive, factor into your hypothesis, so theory side, and into your findings, so empirical side? That's the first one. Then I got two more. The second is, in some of your tests, you exploit cross-country variation in environmental norms, which I like in general, but I was wondering whether this characteristic may be correlated with other firm level characteristics, like, let's say, investor protection rights, market development, wealth, and maybe it's that what drives the findings. And then third comment, maybe we could do this at the end. It's not related to the paper, actually. It's more that at the beginning, you were talking about your other work related to climate change and finance. And I think it's clear that you really care about the topic. And what do you think are some of the open, important questions that should be addressed in further research, for instance, by the audience here?
Definitely something for someone with asset pricing skills like you. So great points, Heiko. Thank you very much. So let me start with the investment philosophy, active versus passive, or the philosophy more broadly. I think basically there are two ways, I'm simplifying now, on how investors incorporate climate risks in the investment process. It can be through engagement or through divestment. Right? So what we're capturing here is engagement, because capturing the effect of the threat of divestment or divestment itself on disclosure is something else one should probably consider looking into, right? So that the threat that you say that unless you're fixing your disclosure, I'm going to sell my shares in your company, and whether there's evidence for that, I think that would be super interesting to show. So here it's more about engagement. One reason why we focus a lot of engagement, apart from not knowing exactly how to look at the other part, is that because out of our other paper, we had this evidence that at least the majority of investors, when considering climate risk, preferred the engagement channel over the divestment channel. Right? That seemed the broader evidence. But you also raised this question about active versus passive, which I think is an important question. So the big three passive investors, we classify them as universal, right? As universal owners. But actually, there's a lot of evidence that they are not passive when it comes to climate issues. There's a paper forthcoming in the JFE that shows that firms where there are lots of these big three investors, that these firms are reducing carbon emissions, right? So, which suggests that in their governance stewardship activities, they're successful in mitigating the risk. And because of the universal owner reasons that I gave, because of the externalities, that's very plausible. These investors, the big three, they should care a lot about climate risks, because the climate risks affect the portfolio very broadly. But I think what's important to point out is that we're not just capturing here the effects of the big three in our universal owner variable, because also we have lots of universal owners in our sample that have these broad holdings that are not the traditional, passive investors, but are very active investors with very broad portfolio holdings, where we know that they're very active in governance and stewardship and ESG, activities. I think the other point, maybe I should clarify a bit better the cross-country variation. So it's at the investor level where we look at the norms. We're not looking at the firm level. I think that would be interesting as well, because you would probably predict that the effect of institutional owners on disclosure should be stronger if the portfolio firms is in a country where you have high environmental norms. I think that makes a lot of sense. That's not what we're looking at. Probably would already be worth another paper to look into. And then you would clearly have these kind of other country level variables that are driving things. Now we are accounting for country fixed effects more broadly, because you're absolutely right. There are different regulations across countries, and different disclosure standards more broadly, and so on. So we're trying to absorb such variation as well. Now the open questions, I think there are lots of questions that are worthwhile exploring, especially given the importance of the topic. Right? So if you think about the journal space devoted to climate topics at the moment, it's way too little compared to the importance of the question. So I think much more needs to happen. And just basic questions: how are climate-related risks and opportunities priced in equity markets? So we have some initial work that goes in this direction by Patrick Bolton and Marcin Kacperczyk, for example, that shows that carbon emissions seem to be priced. So firms with higher carbon emissions have higher returns. But what about the physical risks? There's some work, but more needs to be done on that as well. What about the opportunities? But then also questions like, how are changing investor demands affecting the pricing of climate-related risks and opportunities? As we have more investors coming in to the market with ESG preferences or beliefs, this should of course affect the pricing. So what are the roles there? And many more issues to look into, right? Also the measurement, how do we properly measure climate, firm level climate change exposure? I have this paper, but there's much more to be done, again, given the importance of the topic. So these are just some thoughts on what could be important to look into.
Thanks a lot.
Do we have further questions from the audience? Anyone? Christoph, yeah?
Yeah, thanks for that very interesting talk. As perhaps you are aware, I'm coming a bit from a different background, having been trained as an energy engineer originally. And I'm sometimes wondering whether people like you are a bit too optimistic, and I'm trying now to pour a bit water into your wine about the optimism about capitalism saving the climate. Because, well, first, the effects that you are measuring are in the single-digit percentage rate. Second, you are measuring very low-cost actions. Disclosing climate exposure is very little in terms of cost compared to really taking climate action. And if you compare the costs that large firms put into that activity compared to the cost they put into lobbying, and at least in the past, I would argue, and still now, when it comes even to German large companies like BASF or E.ON, when they do political activities, it will not be to strengthen climate action, or at least to strengthen that type of climate action which doesn't conflict with their own interests. For the moment, I think one important debate we have inside Europe, I think there are several aspects on that, but carbon border tax adjustments. I haven't seen any of the large emitters in Germany arguing in favor of carbon border tax adjustments. So any ideas how to combine that with your research?
Yeah, no, I think it's very important to stay skeptical. I think that's exactly what we need, and we need to do more of this. I'm fully with you, and I think there's some positive lights, positive signals showing up here and there, and I think a prime example could be ExxonMobil. I mean, what's going on at the moment with the proxy fight with ExxonMobil, I think it's massive, and let's see what the results are going to be. But I don't think this is something we would have expected 5 years ago, right? So that there is an activist investor that is aggressively basically saying that the company is not fit for the carbon or the transition to net zero. And that they realize that there's a lot of value at risk and they need to change everything fundamentally. And I think we'll see more of these cases. And also thinking about disclosure and your comments about the lobbying activities. I mean, one question in the CDP survey is whether firms are participating in lobbying activities. And I think it's important that this information is disclosed, and I'm sure already now and moving forward even more so, firms will get a lot of pressure if they're supporting lobby groups that are kind of questioning climate change, right? And I remember having read that this is exactly what happened in the US, that several of the big companies have stopped funding lobby organizations that were kind of challenging that climate change exists. Again, I would also say, let's stay skeptical, let's push them even more. Let's hope this is all continuing much more. But I still believe that, maybe we can have more trust in money than in political regulation, because some of the pressure that comes from the money side has in the background that regulation will happen. but not in all cases, right? If you think about the physical risks that investors are facing, if they have a lot of real estate and so on, right? That really gives them an incentive to engage firms to reduce emissions, because if they hold portfolios, they will be affected by climate change. So they wanna combat it out of monetary reasons. So therefore, I would say let's not become complacent and say, you know, this will all, you know, settle, but let's you know put the pressure even further on investors to go this alley. And you know, I think it's a matter of fact that we have some important investors pioneering this, but not all of them are doing it, right? We have too many that are still passive, that haven't recognized fully what it means, what climate change means, and what needs to be done, right? That's also what's coming out of our other paper, right? The majority of investors have just started to understand what needs to happen and how they need to change the investment process. So, you know, therefore, you know, it's probably better to say the glass is half empty than half full, because you know, this way we can put more pressure on change here.
Thank you. Perhaps a more detailed or question more going into one detail that you mentioned. You mentioned scope 1, 2, 3 emissions. How good, or my rather brief look at carbon disclosures of large German companies, my impression was that scope 1 is now getting more or less standard, but especially when you think of non-basic materials and non-energy firms, then the scope 2 and scope 3 emissions are more important. Think of the car manufacturing industry. What they produce as greenhouse gases on site is small compared to what is embodied in the steel and the aluminium that they are using for their products.
I fully agree. That's what we also observed, and I think consistent with this also, you know, what this finding that we have for Climate Action 100 Plus, that it seems that the effects are strongest for scope 2 and 3 emissions. Right, that's where they seem to put the most pressure in terms of at least the verification. So I think that's very much consistent with what you're saying. Yeah.
Thank you.
Right. So thank you. Do we have any more questions from the audience? Okay, so then maybe I can ask a last question. Question I always ask our speaker at this seminar, Zacharias, where can we take you to dinner? It's unfortunately not possible now, but at some time in the future, we will do that. For the time being, we can only say we had I hope emission-free seminar today. I think it's our first one, and thank you all for coming. In particular, Zacharias. So thanks, and yes, we'll have an ongoing series now. Basically, we'll do that every 3 weeks. From now on, you can find information on that on our webpage. The next speaker will be Professor Wossebel from the TU Munich, and he will speak on a topic more towards energy trading. For now, I have one more thing in the chat. Yeah, it's just thank you. Okay, excellent. So thank you again, Zacharias. Thank you all for coming, and I hope to see you, at least your names, next time again. Thank you very much.